Hello and welcome to the Trading Zone. I'm Joe Teague, portfolio manager of the Rational Equity Armor Fund, former VIX and S&P 500 pit market maker and the options market maker. I'm here with Brian Stutland, also of Equity Armor Investments, portfolio manager, Rational Equity Armor, and former VIX market maker. Brian, how are you doing?
Good. Feeling really good. My Bears are on a 4-game win streak, so feeling good about the weekend. Michigan got a W against the UW of Washington. So things are rolling here in the fall football season. But as we talk about fall, we've got to talk about all the volatility we're seeing, which September, October, normally the more higher vol times of the season for the markets. Joe, what are you seeing so far?
Yeah, I see the Bears, and that's just a great story. I just see them as like the Lions Junior with Ben Johnson there, just doing all the things the Lions are doing. It's really cute. I really like those Bears. It's fun to see. I'm happy for you guys. But yeah, you talk about fall. Yeah, we saw the VIX fall on on Friday, Brian, and I think we want to talk about that in our show. I think there's some really critical things to know about what happened on Friday. So that was. It was absolutely historic. So let's take a look. Of course, here's the VIX for 2025. It's been very eventful. It was kind of an uneventful end of the summer. We had the dog days of August, and then boom, we had some volatility come back in a heartbeat. And it really hits you when you least expect it. Of course, that's just the nature of the beast here. And we had that truth come out talking about new tariffs with China, and the market went haywire. And we had massive increase at the end of the week, on culminating on like a big pop at high on Friday. And intraday, we had a 28% drop from high to low in the VIX. Brian, I'm going back in history, can tell you this hasn't happened very often. There's actually very few times in history we've seen that big of a drop, 25% or greater. And I went back and looked at those times, looking out 3 months later, what's going to happen with the market after you see that big of a drop in the VIX. And here's actually the returns. These are the periods here. It's actually an average about right here, about a 9% return over 3 months. That's actually outstanding, of course, if you're thinking about what's going on in the market. So just thinking back historically, big increase in fear coming off in a big way. And the markets rallies off of that. I mean, just thinking about what happens when you get the VIX popping. People are worried about something catastrophic happening. Somebody who knows something, maybe banks, maybe people with inside information about what these positions are, know, hey, this isn't a credit crisis. This isn't something that's going to collapse the system. And they come in and they sell the volatility off of that peak.
Joe, what's that one that it's the lower, where the market went down almost 20% just right after? What year was that?
That was 2020.
Okay, so
that was the COVID situation.
Right. So I guess my point is, if we're not COVID, if we're not in a pandemic, all other signs look for a pretty bullish market over the next 3 to 6 months. Would you agree?
Yeah, but if you go back and look at this, like in the next couple of weeks here, could see some chop, could see some turn for the next couple of weeks for sure. In fact, history would suggest through the rest of the month we're going to see some volatility, and then more than likely pick up in November, which actually coincides. Seasonality is actually really good time for the end of the year, really good time for tech stocks, which of course is leading this rally.
Yeah. However, I would make the point that, the couple of years where it did stay higher, it kind of trended there for the rest of the 6 months, although the gains happened like very suddenly right after the VIX drop, right? Is in those 2 years, you got the market rise, and then those markets kind of went sideways the rest of the year while everybody else that declined went up. So the question is, do you buy this market now, Joe?
Well, I think I 100% I am a fan, especially just kind of looking at like this volatility here, kind of looking at this move index, which, you know what, this is kind of borrowed here from last week here, but this move index did not really peak up here, Brian. Did not get back here up here at 90. This was not a sign saying, hey, these bonds are really going out of control. There was nothing in the system saying look out, beware here.
Yeah, a little bit of an uptick, which would suggest valuations need to be a little bit lower, but nothing out of the ordinary. Kind of like you said, those lines in the sand right there. I'm not going to get too concerned about the bond market until I see a volatility pop in bond pricing action above that. And then you look at the skew here. This is downside put buying relative to call buying, so to speak. In other words, the premium value put on a downside put relative to the same upside call. We did see that spike along with the VIX as well. That has come off. Usually a pretty good sign when that comes off of its highs that at least we're starting to see some call buyers come back into the market here. So I would probably look. I'm just kind of looking at this level here, looking over at my screens. Yeah, like like a 5 on the skew index below there would probably be pretty bullish. I think that would show signs that real good call buyers are going to come in. So we'll keep you updated on that as sort of the week progresses into next week, but it's looking more positive in that sense.
Yeah, no question about it. Absolutely. Here, I'm just kind of just bear with me here. Having some questions here with my PowerPoint here. What's going on here?
Well, while you kind of like fix that, also we like to always talk about VIX futures and how those are behaving. And what we're seeing really is obviously VIX futures getting crushed today. If you look kind of like a month or 2 months out, they would be a little bit lower, suggesting that maybe volatility has a little bit more to come in to mean revert to where it was before. Anytime we've seen the VIX sort of get around 15, it's really been a buy indication for the VIX. We'd be looking probably to add. Late in the week when we saw volatility pop, we took that opportunity before that reversal to maybe take some volatility futures off the table, lower that exposure. 25 was kind of like a no man's land really for me in terms of do I want to be longer or shorter. So since we were longer back down at like 16, 17, it was like, okay, let's just take some profit here and then buy some equities lower, which we did. So that was a pretty good move there. I think the move we're seeing in the NASDAQ now, moving higher here, all bullish signs indicate, maybe volatility stays a little suppressed from here on out. Well, I mean, that kind of concludes our little volatility part of the show. We also like to talk about the big macro picture and what's going on ahead for the week ahead here. Joe, what are you seeing in the equity markets, our macro view on the markets as we sort of get into that? And we've seen this chop occur over the last few weeks.
Yeah, so bottom line is great recovery on Friday and today. Really encouraging to see leadership coming back from the semiconductor index, of course. Let's take a look at it. Just really big turnaround in the S&P 500. No need to explain that. NASDAQ, for its part, looking even better than the S&P 500, very close to an all-time high, which is where, I want to point out, boy, this semiconductor index just fantastic. These chips are leading the way. NVIDIA,
is that a new high today then for the semis?
Yeah, new high this morning. Just NVIDIA blowing out of the water and just putting the market on its back and carrying it. And I think maybe next week I want to talk about people talking about the bubble and the infrastructure around NVIDIA. We talked about this briefly. Brian, we talked about everything, how NVIDIA has this investment in OpenAI, and they're giving OpenAI money, and OpenAI is taking that money, turning around, getting a $500 billion valuation, taking that valuation, getting loans, spending money, and going out to Oracle. And then Oracle's going back to NVIDIA in a circle saying, hey, I need to buy some chips from you guys to build out this infrastructure. So it's kind of a thesis, a narrative that this is just kind of paper and just money circling around, and it's not really doing anything. But there is the money is actually doing things. They are massive data centers being built. There are massive fabrication chip centers being built. There's a gigafab center in Arizona. There's in Ohio, there's Intel's plants, which are just massive. There's the Georgia cloud infrastructure, just super center. So it's just massive big building projects, which is money going in the system. So it is going somewhere, but it is fascinating to think. I think people are talking about these valuations too for the bubble too. So
I mean, the thing is, I've heard a lot about the circular talk or whatever, but the reality is you can't. It's almost a form of a barter system. The money then has to leave somewhere, which is being built in data centers It's being built in electrical costs, which is probably why you want to have some sort of managed futures portion to a portfolio right now. If I had to like equate to what you need, I also equate it to the 90s of like the build out of the internet infrastructure. That bubble did not burst until people were bringing products that people were not using, like pets.com. Okay, we're not seeing that yet. Everything is being used in the circle system right now. And so, as long as there becomes profitability in this circle, where OpenAI starts turning a profit, where Grok is turning XAI is turning a profit, where Anthropic is turning a profit, where robotics are becoming more used and utilized and becoming profitable. So I still see that happening. And this gets to this chart right here is where are we right now? I think we're in 95, 96, right? We are near the beginning. The movement in the market is similar.
We remember this chart. I lined it up as to the first rate cut for the Fed. The Fed cut rates in 95, the Fed cut rates in 2024. That's how I lined this chart up, Brian. I think it's kind of a liquidity-driven cycle. We had a crisis in 98. There's no guarantee when that crisis will be this time around. But my assumption is there's going to be another fresh wave of liquidity thrown at this market. And that's when we'll start to see things going parabolic. When we see that.
So is that really like, if we're where you point, you are here, and let's just assume that this recent little sell-off, this little blip, was the sell-off that you saw in
the big scheme of things. But go ahead, yeah.
Well, if this sell-off that we just saw like in the last week or so is the same sell-off that you saw there in June of 96 in the chart, what is that, about a 40% rally off of those lows to the next, leg up that you kind of circled from where you are here to the like next, that little leg there. That looks like about 40%, right? So, and going even higher. I mean, that little extra blip is really nothing. That's really like right there that you get any sort of significant pullback. So you got to be careful of that. And that's why I want to be long equities, but we don't know if we're in the vertical bubble. We hear people talking about bubbles. So that's why I'm owning volatility with my equity position, and I can sleep at night and feel pretty good about it. Look, the equities were up and VIX was up during this time frame, and that's why our rational equity armor strategy is outperforming the S&P this year, because the V-shaped recovery off of April and the rip higher is enormous. I've got to own some volatility with my equity position, and that's how I'm really playing it for a bulk of my own personal portfolio.
So speaking of bubbles, yes, we know Bitcoin's kind of not really showing like a conviction one way or the other here. But speaking, of course, of bubbles, we do have another area of the market which has just gone parabolic. Now,
I mean, every day I look up, Joe, it's like gold up 2%.
It's amazing, and it's so fascinating to see and think about how people are talking about the stock market as a bubble. And we're talking about, the AI and the Mag 7 specifically when we're talking about this bubble and these companies with really high valuations. And yes, these companies do have to produce quarter after quarter for the next few years to justify these high valuations, but they are actually making something. There is some real tangible value behind owning shares of a company. We can say, hey, if it pulls back, I would want to buy more. It's going to be worth more, per share now at this point. But that's not necessarily the case, of course, with gold. Gold doesn't produce anything. It doesn't own any share. And I actually, I talked about this, Brian, of course, Brian, in our blog every week briefly. I've been talking about gold and the potential for this being a bubble, but it's just really fascinating. You see stories, I go to Costco and it's like, wow, they got gold here at Costco, and they're actually selling out like hotcakes. You hear stories about in Australia, people are lining up on the streets to get a piece of gold. In India, of course, coming close to that season. Actually, I mentioned it's Diwali, so it's a very popular gift. But it's just, there is a mania and people are talking about it, and people don't think of gold as a asset that has risk. They think of it as like the risk off asset. And that, to me, yes, I've been bullish on gold for a very long time, but I just need to point out here that this is a little bit of mania here. Let's just take a look at gold pulled back just a little bit further. This is the all-time chart in gold. And yeah, I'm just going to put this here. I'll let you decide what you think of this.
Well, I will say one thing. There is some similarity to that chart with the U.S. debt, right? So as it's expanded and grown and there's really no answer for it, now the government is shut down, which is making, I mean, if the U.S. government's not operating, what's the value of the U.S. dollar, right? So there is some comparison where I could say, look, as long as government debt keeps increasing across the world, then gold should keep moving higher like it's doing right now. However, maybe when the government gets back up, this little bubble starts to pop in gold. Obviously, the other counterpoint to gold going higher is quantum computing. What happens if that takes over? Do you have to just own a gold bar at that point? It's because anything electronically is going to go to nothingness. Well, I mean, Joe, you and I still operated on the floor. Maybe you got there a little bit later than I, but I still saw paper trading. People did exchange an economy in the prior to 1990, I believe, when there was electronics. Everything moved slower, but it still worked. So, I mean, we might have to go back to that one day. So that's another reason why, gold could be a little bubble-ish here too. But I think the debt thing is an issue. I think the government needs to get back up and operating for this to sort of, put some more confidence back in the U.S. dollar. But, geez, I don't know how high can this go? This looks like the tulip chart, right?
Yeah, I mean, it looks like the tulip chart, but it also seems like, governments and big institutions, they were buying around here. They were buying it around here. And it seems like right now the big buyers are just the individuals, the retailers, I think the bag holders, unfortunately. I'm worried about just a short term. Now, if you tell me what do I think gold is going to be 10 years from now, I will say it's going to be higher than $4,300 an ounce. It's going to go up in 10 years. I'm just very worried about the next year or so that it could. This was in in 09. This is really nasty pullback here. I think something like that is unfortunately what we're due for here in gold.
Yeah, we might need a signal though for rates to go higher for that to happen though. But I don't know. It's obviously the move is crazy. It went crazy though before that, right? From 03 to 2012,
Sure.
the move was pretty significantly pushed higher. So we could be in that same sort of cycle. But if I'm looking at like things coming in three legs, like we've had three legs, 1, 2, and now we're in the third. So we're in the late stages of where the valuation of gold can be. I'd be a little cautious. We still own it in our portfolio for clients, by the way, though. Having said that, but it's something that we want to take off, and it's something that I'm not going to make too high of a holding in my portfolio at this point.
Well, yeah, and then absolutely just rebalancing, bringing it back down to its original weighting is something we do too. So it's just something we're watching out for. Of course, as we go, it's something we've been bullish on. I just want to make it known. It's not like this is a risk-free investment. Okay, I think we all get that. Finally, before we get to our trade of the day here, we just want to look at oil. I just think this is like the best thing for the stock market and for the economy is that, yes, there is kind of inflation in a lot of different areas, but the most important thing for the economy to not be inflating is oil. Great news that it is on the lower end of the range. This is something that could trigger a recession. If you saw oil above 120, if you saw oil, above 100 for an extended period of time, you will see economic damage. This is just kind of like a tax cut for the whole economy. It's just the economy is going to be doing a lot better because just about everything that's produced is cheaper.
Yeah, and what's interesting? Not just this crude chart, but I was looking at other commodities recently. Everything looks like crude oil right now, really. The only thing maybe like upticking we see right now is lumber, which actually could be a bullish sign that maybe housing is starting to get going, and that portion of the growth part of the economy that utilizes lumber is going. All the other really commodities, wheat, soybean, et cetera, have seen like this sort of decline similar to crude. So for all the talk about tariffs creating inflation, it looks like commodity prices are headed lower. Um, so it's really just gold leading the charge in that realm. So we'll see what happens here. I think, like you said, it's probably a tax cut for the economy and GDP.
Okay, so getting on now to the trade of the week. This is something we do every week. Remember, if you want these sent directly to your inbox multiple times a week, seeing all of our trades as they go, make sure to subscribe to that. You can check that out at equityarmorinvestments.com. Click on the trading zone, and you will get that sent directly to your inbox. And this week we did another trade on Google, and I think Google is my favorite stock right now here, Brian. I think Google Google is just everything. I think it is the best stock in this cycle. It is their dominance is just rooted across several factors. They're strongly positioned in the cloud, of course. They're leading the race in quantum. They're demonstratively ahead of robotics. They have the driverless car technology, which is ahead of Tesla. And of course, they're well positioned for the new wave era of the AI evolution. Google, for me, is just everything. And now here we are coming on to all-time highs, and it is just fun to see. We have a trade on in Google, of course, Brian, where we're long the 240, 260 call spread through December. I think that is going to stop us out at 260. I want more upside. I want to own this through 290 now. I'm going to up my target. I mentioned at the top of the show, we're going to have positive returns for 3 months if that VIX signal is correct. So I'm looking out to January. I'm looking out to the January 16th expiration. I want to sell the 250, 220 put spread, buy the 290 or 260, 290 call spread here. Brian, it's going to cost me 95 cents to get into this trade. Yes, I have risked it downside if Google does pull back. I'm aware of that, but I am getting into this call spread a lot cheaper than otherwise.
Yeah, Alphabet is the play here. It's my biggest, I think, single stock holding. It is close to up there. It's definitely in our top 10 for our rational equity armor strategy. It's a name, like you said, holds everything. And then you look at the option trade there. So the less than $1 cost really to put that on. So what that means is from 260 to 290, you make $30. From 250 down below, you would start to lose money 1-to-1 until you get to that long put on the downside. So what that means is in between there, you pay $1, that's all you lose. It gives you like a little bit of a cushion to the downside. It acts very similar to being long the stock itself. If you look at sort of like the delta play out, but it kind of like caps your losses on the downside. Yes, you're called away a little bit on the upside. If you want to wait to sell that upside call on the 290 call, I'm okay with that because I'm actually pretty bullish on the market right now. So I'd almost like do this trade, buy the 260 call, sell the put spread, wait to sell the 290 call till we get a little bit of a rally, and then play it like that and trade it, so forth. But yeah, this is I think this is the play for the last quarter here. In the equity markets, I can just use this one option trade overlay if I need to get more exposure somewhere.
Yeah, and of course, I'm looking at outlaying very little cost. This call spread here, Brian, is I don't know why it's doing that. It's $10 here. You can see, actually, you can see it right here. This 260, 290 call spread is $10. So it's kind of expensive to do so. Turns my max gain from $30 or $29 down to $20. So I'm looking to augment that, of course, by selling a downside put spread. I, of course, have very strong upside conviction here on this trade. That's why I'm designing it like this.
Yeah, based on where the stock is trading, right around 256 or so right now. So basically, you have like $6 to the downside before you get hit on the short put that you'd be obligated to buy Alphabet. And obviously, you've paid almost $1. So you really have like a $5 cushion, which is about 2% of the value of the stock. So think of it this way: stock goes down 2%, I don't lose anything other than the dollar. If it starts to go down more than that, then I do participate 1-to-1, but I'm stopped out with that other long put on the put spread, right? So I limit my downside. I give myself a little cushion on the downside as well. And then I get all the upside from 260 to 290, $30 move, over 10% return on my money in less than 6 months, expiration in January. So you got Nov, December, January, 3 months, and then you're out of this trade to return over 10%. That's a pretty good annualized return, Joe, if that actually happens. So love the trade. Great trade. Keep tuning in every week on our show here. We're on every Monday at noon Eastern. Eat your lunch. Listen to us. I think we got a lot to say. I think we've gotten some good advice on the Trading Zone. Go ahead and subscribe on our Trading Zone site, equityarmorinvestments.com. Check that out. Get your subscription now. You'll get these trades directly to your inbox. Even as we update the trades too, you'll get those as well if we need to get out of something. And tune in next Monday, noon. We'll see you here on the Trading Zone, noon Eastern, every Monday. Eat lunch, watch us. That's peace. Signing off. That's me, Brian Stutland, Joe Ige, Equity Armor Investments. See you later.
You know how the financial world goes. Here comes the buzzkill. Please make sure to take some time to read this boring disclaimer. We will owe you one.